we just have some other miscellaneous provisions. Like-kind exchanges, you used to be able to do, we saw a lot of like-kind exchanges on auto, sometimes pieces of equipment. You might have a like-kind exchange where you don't recognize a gain on the sale of the piece of property that you're exchanging. Well, those exchanges are still out there for real estate, which is where the biggest implication lies, where you usually have appreciation on a piece of property. You can still do a like-kind exchange as long as it's not inventory property. You can still do that exchange and escape taxation if you don't take the money but exchange it for a different property. But you cannot do it now on tangible personal property. Because you can take full bonus depreciation on the new piece of equipment in tangible personal property, that's probably not a big, doesn't have probably a very big implications for many taxpayers, but it is a change. They did talk about changes with research and development, but there has been no change to the credit. One thing that they did do with research and development, and this doesn't apply immediately, but will apply effective for years beginning after January 1st, 2022. You used to expense immediately your research and development expenses, and now you will need to start amortizing those over a 5-year period. So that could have some big implications. And I already had mentioned the repeal of the domestic production activities deduction, but that is gone for years after 2017. Another small change was on self-created property. This is something that if you were coming up with something, say that you're going to patent, and you sold that technology, you were the one that developed it and sold it, that will now be treated as ordinary income property instead of capital gain property. Could be models, designs, or secret processes. Any of those items now will be ordinary income instead of the more favorable capital gain. They did come in with a new credit that is the employer credit for paid family and medical leave. It does have to be a specific plan. You can't just say that something you currently have or are giving your employees for vacation personal is under this particular provision. It's other than vacation or personal time off that you're currently giving. But there is a 12.5% credit for 50% of employees' normal wages. They did tinker a little bit with an employee achievement award. If you had a length of service award, you can still do an employee achievement award for length of service or for safety, but you cannot give a gift certificate or a cash or something that's easily convertible to cash. You can still do golf clubs or a watch or something similar tangible personal property as an employee achievement award. You just can't take a deduction for doing something that would be a cash or cash equivalent type item. Getting to a couple of the last slides on the business deductions. Meal and entertainment has been a big one. We still have in place a 50% deduction for meal and entertainment, for meals that relate to travel or employees' travel or use for business. What is gone now is any entertainment expense. Those are non-deductible. So if you do take somebody out for a golf outing, the round of golf is no longer deductible. We had already seen that the club due for joining a country club was not deductible, but now they've extended it to entertainment that you might do. Or perhaps it's tickets to a Bucks game, no longer deductible. You can still do it as a business, obviously, if it's for business purposes, but you won't get the tax deduction. What we would recommend here is as you're running your business that you segregate your costs now rather than waiting for the end of the year when you're going through, and we're going to ask you the question, how much did you spend on entertainment? So start a separate general ledger account would be a good idea to segregate out those costs if you do have any. There was also an expansion. There were some situations where you may have provided meals, perhaps through even a facility at your own employment, at your own company. Those facilities now are 50%, the meals at those facilities are 50% deductible. They were 100% deductible, so that is a change as well. They are going to be non-deductible in the future, but that is several years off at this point. They tinkered a little bit with the membership dues. I had previously mentioned country club dues were not deductible in the past. They've added the word business, pleasure, recreation, or social purposes. Those club dues are not deductible as well. And if anyone did previously provide transportation benefits, this might be parking, say, downtown, or carpool, or other fringe benefits related to transportation benefits, those are no longer deductible. It doesn't mean that if you provide them, the employee, it can still be excluded from the employee's income, but it would not be deductible from the corporation. And now, because I think you're probably tired of hearing me talk, I'm going to turn it back over to Mike so he can move on to the accounting method changes that are out there.
Thanks, Jana. So we're just about done. Just a few other things to cover here. Like Jana said, we have some accounting method provisions. So under this slide, if your business has had average gross receipts over the prior 3-year period, there are some changes which may necessitate some additional conversations and consider potentially some method changes. So if your business falls within this category, and a lot of our clients do, there are some things here that we want to cover. So the first couple really relate to accounting for inventory. So, and these are all good provisions, I would say, is that there's going to be less restriction as far as accounting for inventory for tax purposes. We're allowed to use the same method as used for financial statement purposes or treat as non-incidental materials and supplies. So, so that, in most cases, we'll probably be relying on what's used for financial statement purposes. But the second item there is the elimination of the UNICAP rules for taxpayers that fall within these guidelines. Again, 25 million in gross receipts. We'll be looking, this case, for 2015, 2016, 2017 gross receipts, divide by 3. If we're less than 25 million, then we can apply these. That UNICAP elimination, that I can envision that being fairly significant for a number of taxpayers. You may not keep track of it that much because it's just this item that creeps up or down a little bit each and every year, but over time, if we've been growing the business and 10 or 15 years have passed, that could be a really large deduction that we're going to get in 2018. We'll have to keep our eye on that and certainly be in contact and communication with you on it, because that could certainly affect kind of the planning that we do for 2018 as well with tax estimates and whatnot. A couple of other provisions. These are two, the cash method of accounting becoming available regardless of whether the purchase, production, or sale of merchandise is an income-producing factor. So historically, businesses that fell within that category for maintaining inventories, things like that, were required to be on an accrual method of accounting. But the cash method now could be available. So that's one of those items I think will really necessitate some separate discussions one-on-one with our clients to determine if it makes sense. In some cases, it could actually be detrimental depending on which way your receivables and payables are going, but it's certainly something that we'll want to be in a communication with you on and determine what the best course of action is. Also, long-term construction contracts, which would historically been required to be accounted for under the percentage of completion method, can now be accounted for under completed contract method. So that's another one of those that will just require some separate analysis and talking with you folks as far as what the options are there. Okay, so last couple slides here, we'll touch on international tax, and I think we'll be pretty much wrapped up. So the international tax provisions as part of this bill, just highlighting, no changes have taken place for IC discs. However, the benefit will certainly be reduced somewhat, and that's just based on the fact that the spread between the qualified dividend rate, which is 23.8%, that stays constant, and the top rate potentially, or the rate for businesses that say get this qualified business deduction, as Jana mentioned, 29.6%. So there's just not, and for those of you who have them, you know what this computation looks like, and that value is just reduced. Now, some folks have asked, should we get rid of our IC disc? And my comment to that is, if you already have one set up, I just don't see any reason to terminate it at this point. There's still going to be some benefit to it, but if you were kind of on the cusp of whether it made sense or not to do it, I think those thresholds for international activity have just escalated pretty significantly. So the next bullet point there, so this is the big change going forward, is this movement from a worldwide system of taxation. Again, and Jane had touched on it earlier, as U.S. taxpayers, we're taxed on our income wherever it is generated or earned, and even in some cases it might be deferred over in a foreign jurisdiction, but ultimately when that income comes back in the form of dividends, it's taxed again in the United States. There's foreign tax credits, things like that. But generally, that's our U.S. taxation system, or historically what it was. So we're moving from that system to what's called a territorial system of taxation, where your income tax is paid where, in which jurisdiction it is generated. So that's kind of where things are headed going forward. In order to apply those new rules or provisions, there's this third bullet point there, an exemption from U.S. taxation for certain income attributed to foreign subsidiaries. So in this case, there's a 100% deduction of foreign source dividends, and that would be from 10% or more owned foreign corporations. Okay, so that provision is only available to C Corps, and in fact C corporations that are not RICs or REITs. However, there's this new inclusion for what's called global intangible low-taxed income. So despite what I said about moving from a worldwide system of taxation to a territorial system of taxation, this bill includes some provisions which, at the end of the day, are effectively going to tax some of that foreign income in the U.S., depending, and this is where, Jane had talked about it earlier, regulations and more guidance needed from the IRS as far as applying some of this, but generally speaking, to the extent that we have this global intangible low-taxed income, there will be a tax in the United States of 10.5%, which is exactly half of the new C Corp rate of 21%, and then that ticks up after 2025, and that is available only to C corporations that own these foreign subsidiaries. For non-corporate taxpayers, they'll pay tax at the regular applicable tax rates, which would obviously include your S Corp shareholders as well. And the whole idea with that global intangible low-taxed income is really to preclude U.S. companies from moving low-basis assets into foreign jurisdictions and just continuing to make more and more money over there without necessarily any consideration for sending it back to the United States. So that's in there to at least ensure that there's some U.S. tax on our U.S.-based multinational companies for the most part. Last slide. So we talked a little bit on the previous slide as it relates to international tax issues is what we're looking at going forward. So in order to look at what we're doing going forward, there has to be something we have to take care of for all of our accumulated profits that we've been building up historically to get to this point. So what we have is a transition rule here for current deferred income, and it's highlighted there's repatriation of accumulated foreign earnings. So there's a specific tax rate that the bill includes. So it's 15.5% on cash and cash equivalents and 8% on other properties. So to the extent, it's essentially your retained earnings for the most part that your foreign subsidiary has accumulated over time. And now we're going to pay tax on that. And that tax is going to be paid regardless of whether we bring those dollars back or not. So, as part of this whole bill, whether it be a windfall of tax revenue as a result of this, there certainly will be a lot of that. And I don't know if this is going to be good or appropriate for the economy and all that kind of stuff, but there will certainly be a lot of tax being paid as it relates to this. However, there is an election to defer and pay it over 8 years, so it's not something that's going to come through all at once. And there's a schedule there for the timetable for paying that tax liability. And under all of the provisions, there's no interest attributable to that, so unless there's some unique circumstance, I don't know why any taxpayer would not make the election to defer and pay it over that 8-year time frame. So that applies for C corporations. Now, S corporation shareholders, that next point down, actually have an opportunity and a little more flexibility. They can continue to defer payment until a triggering event occurs. So they define that as either termination of S corp status, liquidation or sale of the assets of the S corp, or transfer of the S corp shares. So the S corps that own a foreign subsidiary that have these the accumulated earnings in them don't have necessarily an immediate tax that they need to consider as long as they continue to operate the S corporation, no sale takes place, no major share transfers as well. So a little more flexibility for them. There's also various changes to the Subpart F rules, and some of this it's way beyond the scope of this hour and 45-minute discussion. And these international tax rules are quite complex. And like some of the other things I talked about too, these are just going to necessitate some separate discussions. We have pulled a list together of our clients that have foreign subs. We're continuing to stay on top of the guidance that's out there and getting educated as how some of this will be implemented, because for some of them it will be a significant event that needs to be handled properly. So with that, I don't have anything else other than my comments. So again, just thanks for being here and braving the elements out there. It was great to see this many people. I was thinking it might be a third of this as far as attendees. But again, this is where the work starts for us. It was great to get everybody together, and I think just to put some ideas out there for you and some of the changes to the law. But we don't expect you guys to figure this stuff out anymore. That's what you pay us for. So there will be a lot of separate strategic discussions, especially I think that the area that Jana touched on, the qualified business income deduction, is going to necessitate a lot of potentially modifications to the way things have been done, whether it be through salaries, related party transactions, in order to get full benefit of that. So we'll certainly, if we haven't, we'll be in touch with everybody. We've got the tax filing season coming up, so we'll be looking really closely at a lot of the numbers and think about what 2018 is going to look like for a lot of folks, and obviously relay that information to you. So and we'll be around to answer questions and things like that too. So I don't know, Jana, if you had any.
No, that's the same thing I was going to say, is that we will stay around, so if you want to come up and ask us whatever questions, we'll try and field any questions that you may have. Hopefully we haven't totally confused you, but.
Yeah, there's a lot of moving pieces, but like I said early on, I think overall it's positive news for most folks. Just please let us know if you have any questions or other comments.
Thank you.
Thank you.